Welcome to the video presentation on less is more using Technician software. Many times the data presented on a chart can actually get in the way of the analysis. The wiggles seen even on long-term charts obscure the trends we are trying to find, so we need a way to cut through the clutter. Computerized filters and noise reduction techniques can help, but only if you have the algorithms and understand how to apply them. Rather, let's use the tools on hand to simplify the process and see the forest rather than getting lost in the trees. And for that we start with line charts. Most technicians use either bar, candle, or point and figure charts in their work. The first two types use open, high, low, and close data, and the latter uses tick data, so they are all subject to counter-trend movements throughout the trading day. These movements can be knee-jerk reactions to news or market conditions, rather than illustrating the actual trend or technical pattern in force at the time. Using only a closing price line or continuous chart, or even a low interval moving average of the closes, reduces the resolution of the chart, but it also reduces the visual clutter. The first chart shows how a line chart filters out intraday noise, and that includes the mini flash crash seen at the open of trading on August 24, 2015. The market quickly fell at the open, and exchange-traded funds were not able to keep up with the move. Many spiked significantly lower in an extreme case of mispricing, and that trapped many investors trying to sell using market orders. While devastating to investors, the spike distorted the charts as well, and any indicator based on the high and low data, such as stochastics, was also affected. A line chart will not fix these distortions in stochastics, but it will result in a more meaningful chart in daily and longer time frames. Overlaid here on the bar chart of the Select Sector SPDR Technology ETF is a one-day moving average of the close. We can see that here when I mouse over it. This shows one of the more extreme examples of what happened that day. The spike low near the open not only skewed daily charts, but it also skewed weekly charts. The low that day was the lowest seen in more than 2 years and made normal analysis of support and trend lines useless. But a line chart eliminates that spike and shows a more regular, long-term trend break and a pause, which is either a potential channel or a flag-like structure as highlighted here. It makes the analysis quite a bit easier to handle. It is not uncommon for extremes within a day or a week to skew trend lines and other line-based features on charts. For example, an extreme low can create a trend line that is too steep or prone to false violations, and an extreme low can occur below an existing trend line before the market closes back above the line with no official breakdown at all. So here we see the S&P 500 ETF with two trend lines drawn. This is a weekly chart drawn from November 2012. You can see that a traditional line drawn from the low and through the low here in October 2014 really doesn't describe what was going on. But a line drawn through closes, as we have here in red, it's a little bit better of a description of what went on. It ignores this panicky type of low in October 2014 and gives us a better idea of that the trend was over well before this plunge in July of 2015. May not have been the cleanest of sell signals, but it was earlier than a break of the other line. So it did suggest that something was wrong and investors could have sidestepped the decline by holding cash. Okay, let's move on to the next chart. As mentioned, reducing the noise on a chart can help in the spotting of trends. Elliott wave analysis is a specific example of how this can be useful, as wave structure can emerge from the noise of day-to-day changes. But even basic support and resistance setting can benefit with less clutter on the screen. Here we see the iShares Russell 2000 ETF trading in a wide range in late 2014. Defining crisp support and resistance levels would have been difficult using bar charts as seen above. However, when the lines are drawn through high and low closes, a clearer picture emerges. And not only that, both lines came back into use in late 2015, after the ETF had broken out and come back. Just to give you an idea, we'll put this in line format, and you can see that is a much better place to draw this horizontal trading range than using the bars. While line charts are valuable tools, they should probably not be used exclusively. Not all spike highs and lows and other wiggles should be ignored, as the majority represent actual turning points in the markets. Taking a step back from the data can help in seeing patterns in otherwise noisy data, and once these patterns are found, all the data are needed to make trading decisions.